Let's say you have a deposit in a bank, but you are not satisfied with the interest. They are too low, and you want to earn more. But you must understand, the higher the opportunity to earn, the higher the probability of losing all the money. If you are aware of the risks and you have free funds, it may be worth learning to invest in securities that are traded on the stock exchange. For example, a share is an equity security that indicates ownership. When you buy shares in a company, you buy a stake in it. You can receive income from the purchase and sale of shares or dividends, part of the company's profits based on the results of a certain period. A bond is a debt security on which the issuer, the state or the company that issued it, undertakes to pay a certain percentage in the future. The easiest way for a beginner is to buy securities, and after a certain time to sell at a higher price, and so earn. The main thing to remember is that profit is not blind luck, as in a casino, but the result of well-thought-out actions, not a game, but a job. It is not worth investing the last money if you do not have savings and a bank deposit. The modern exchange is electronic. You can trade via the internet without getting up from the couch. But this requires an intermediary, a company that has a license for exchange trading, before looking for it. It is worth determining for yourself a few important things. Theoretically, you can start with any amount, even $100, but such a volume does not compensate for either the commission of an intermediary or the time spent on trading. It is worth starting to invest if you are ready to risk several tens of thousands of rubles. It is better to imagine a situation in which you will lose your money in advance. If you understand that this is not a disaster for your budget, you can try. If you are ready to get trained, immerse yourself in the topic. Study statistics and stock reports in the morning. Follow the charts during the day. You can try to trade on your own. Then you will need a broker who will become your intermediary to access the exchange. You will make your own decisions about buying and selling, and the broker will carry out your instructions. If you do not intend to spend a lot of time and effort on investing, then it is better to consider one of the forms of trust management. In such a system, you make a minimum of decisions, entrusting the investment of your money to professionals. You can conclude an individual agreement with a trustee, transfer money to him, and he will decide for you when and what assets to buy and when to sell. Its goal is to invest your savings with the maximum return at the level of risk that you choose. Another option is investment funds. These are ready-made sets of various securities or other assets, such as shares of Russian mining companies. The fund's resources are managed by the management company. You can choose a suitable fund and buy its shares either from the management company itself or through a broker on the stock exchange. If the company invests well, the price of the shares will rise and you will make a profit. If it falls, you will incur losses. Decide what you will invest in. Stick to a certain strategy. What is a strategy? A strategy is a set of investment parameters that determine your style of behavior on the exchange. What assets do you trade? How often do you sell? What guides you when making decisions? The simplest version of the strategy. You choose assets, the period for which you want to invest, maximum amount of losses. Let's say the assets are stocks of pharmaceutical and chemical companies. The period is 1 year. The amount of losses is 20%. In this case, you immediately sell assets if they have fallen in price by 20%, even if the year has not yet passed. If you have chosen trust management, then you also need to decide on a strategy. Only in this case will you choose from offers that are already on the market, or discuss an individual strategy with your manager. When you decide on a strategy, finding a middleman will be easier. The most important and paramount thing when choosing a broker, trustee or management company is to make sure that they have a license. If you have chosen to invest on your own, you have to go through the following path. 1. Conclude an agreement with a broker. 2. Open and fund a brokerage account. 3. Install a special program for trading. 4. Start buying and selling. If you have chosen the path of trust management, then it will be enough to conclude an agreement and transfer the money to the trustee or management company. Common mistakes. What not to do. You can't invest everything you have in securities. Set aside money for living and unexpected expenses first. Create a safety cushion. Open a bank deposit and only then start stock trading. Invest the amount that you are willing to accept losing. Don't act randomly. Get trained. If you decide to trade on the stock exchange on your own, be sure to complete the training. Most brokers run courses for beginner investors. Trading programs often have a demo mode. You can try your hand at it without the risk of losing money. Don't get emotional. If you act impulsively, you can make many mistakes. A novice investor should not react sharply to the slightest price movement on the stock exchange. But you need to act decisively if the price changes significantly. Set a limit on the losses that you are willing to bear. For example, if assets have fallen in price by 20%, you need to sell and, as they say on the stock exchange, fix losses. In other words, you are willing to accept a 20% loss and end the trade to avoid even bigger losses. The desire to wait a little longer. It will suddenly bounce will be great, but there is no need to succumb to it. Don't put all your eggs in one basket. It is better to buy securities of companies from different industries. For example, when oil prices fall, the securities of all companies in the oil and gas sector suffer. If you buy securities of companies in various sectors of the economy, such as the chemical industry, engineering, telecommunications, this will help you reduce the risk of losing your money. Do not believe promises to earn 500% per day. Only charlatans can guarantee anything in the stock market, and a responsible broker should warn you of the risks. The situation on the exchange is changeable, and only you are responsible for the decisions made. How to predict falling and rising prices? In short, no way, but there are nuances. Graphs. Over the 5 centuries of the development of the stock market, players have tried many approaches that predict the movement of quotes. Investors who trade intraday make transactions daily follow the price charts online. The lines add up to figures that seem to signal an increase or decrease in prices. This approach is called technical analysis. Supporters of this theory have already developed more than 1,000 patterns, and only an experienced trader can navigate this sea. News. More unequivocally, prices react to important events in the life of a company or an entire economy, but only if the event happened unexpectedly. There was news that the US was going to impose 25% duties on steel imports, and steel stocks fell 3%. If investors are sure in advance that some event will happen, for example, they are waiting for good financial statements of some issuer or positive macroeconomic statistics, they start buying shares without waiting for the event itself. As a result, the paper seems to rise in price from scratch. When the expectedly good reporting is finally published, the quotes go down completely illogically. Those who invested in the paper in advance are now selling it at a higher price, fixing profits. The golden rule of the investor: buy on rumors, sell on facts. There are 2 problems with news. 1, there are a lot of them. 2, it is not always clear how the news will affect quotes, and whether it will affect it at all. Coefficients. In contrast to chart divinationists, ratios analysts believe that a stock has a fair price that the stock's real value on the stock exchange tends to. A fair price depends, among other things, on the company's financial performance, current and future. This theory is called fundamental analysis. Fundamentalists take various financial statements of competing companies and compare them with the price of their shares. If a company's ratio is noticeably higher or lower than that of most competitors, then its quotes must sooner or later go down. Dividends. A share is a security that confirms the ownership of a share in a company, and a share in the profits. If the company has earned a profit, it can pay part of this money to shareholders in the form of dividends. It is generally assumed that if a company has paid dividends well in the past, then if there is a profit, it will continue to do so in the future. Expectations of good payouts push quotes up long before the company announces the size of dividends. Analyst forecasts. Stock prices are predicted by analysts working in investment banks. They monitor macroeconomics, news and financial performance, conduct technical analysis, and form a forecast for changes in its stock quotes. The forecasting accuracy of different investment banks is different. It is influenced by the professionalism of the analyst and force majeure, which, of course, he cannot foresee. There is always something going on in the market. Collected all together, the above signal sources generate a real cacophony. Economic indicators rise and fall. Revenues and profits of issuers rise or fall. Companies sue, buy or sell assets, commodity prices rise or fall. Analysts raise or lower forecasts, charts form downward or upward trends. Let's add emotions here. The day is still in full swing, and the stock has risen in price by 5%. The hand reaches for the buy button. The purchased shares are already 5% cheaper than what was paid for them. Urgently selling prompts inner voice. This is how we arrive at the suicidal strategy described at the beginning, which ruins most of the investments of novice investors. Buy at the maximum price and sell at the cheapest. Fear and greed are the two main driving forces behind the stock markets. Those who know how to resist them earn the most on them.